you want to know what can shake your confidence in everything others tell you about investing, in 2025, gold yields were 6 to 5%. Let me say it again, 65, fine. The S&P 500, 4 to 33%, depending on the time you measure. Real talk, gold wiped out stocks last year. But what really caught my attention was that it wasn't retail traders or Reddit communities who bought gold. The rich, the super rich, those who really have money to lose. In just 1 year, the gold holdings of what we call wealthy investors, people with at least 100,000 liquid assets, have more than doubled. We talking about 5% of their portfolio jumping to 11%. This is the biggest asset allocation change we have seen in years. So why do these people know what we don't know? More important, should you care? Please stay, because I'm about to show you the real reason the super rich are quietly moving money into gold while telling ordinary investors to stick to stocks. I warn you now, you don't think so. You see, I've been studying wealth for a long time. If there is one thing I've learned, it is this: rich people don't do things by accident. When billionaires like Ray Dalio talk to us about Bridgewater Associates, one of the world's largest hedge funds, they openly suggest investing 15% of your portfolio in gold, which is not casual advice. It was a statement, and he is not alone. In fact, what market analysts call depreciation transactions are happening. Now, disparaging the word sounds dramatic, right? But stick to my point, because that is actually the core of everything. Devaluation means that the purchasing power of your money is waning. This is not conspiracy theory. This is basic math. It works like this. Since the 2008 financial crisis, central banks, including the Federal Reserve, have been keeping interest rates artificially low for an absurdly long time. For years, we said little. At the same time, they are actually creating wealth. They call it quantitative easing, basically printing money. Then 2020, COVID -19. Another round of large-scale stimulus. Print more money. Then there is 2021 to 2022. Inflation erupts. The Fed has raised interest rates in response, but the damage has been done. Government debt soared. Real interest rates minus inflation, remain very negative. So here we are. The Federal Reserve, the Treasury Department, central banks around the world are in trouble. They create debt monsters that normal policy cannot control. Now, when you're in that position, what is the only option? Continue printing, keep interest rates lower than they should be, and continue to create more money. What about the rich? They saw it a mile away. This is devalued trade. That is why they turned to gold. Let me show you some numbers, because numbers don't lie. In 2025, global gold demand hit a record high of 5,000 tons. This is not a modest increase. This is a fundamental shift in investor behavior. What is the total value? $550 minus $5 billion, up 4 to 5% year on year. But what really stands out, ETFs, gold exchange traded funds. In 2025 alone, 800 tons will be added. The second highest year on record. Think about what that means. Individual investors pension funds, institutions, they don't buy gold coins or sit at home and there is a bar in the basement. They are using modern infrastructure. ETF, that is why you now know it is mainstream. In the United States, US gold demand jumped 144% in 2025. This is the highest level since 2020, almost entirely driven by ETF investments. Now, let's talk about senior people. HSBC released a 2025 survey of wealthy investors. Remember, these people have at least $100,000 in accessible assets, not necessarily millionaires. Only the rich, their gold allocation rose from 5 to 11% a year later. That number has more than doubled. When I say this is the biggest asset allocation shift they've ever seen, I'm not exaggerating. It is not just stocks, bonds, real estate. 50% of wealthy investors surveyed said they plan to buy more gold in the next 12 months. What about the super rich people with 30 million or more investable assets? BNP Paribas manages wealth for some of the world's wealthiest households, which see a 5 to 10% allocation of physical gold or gold-backed investments. That is the family office. Generational wealth. People with more money than most companies. These people aren't gambling. They are not emotional investors. All these people do is make sure their money survives and grows. They are turning to gold. This is where the mainstream financial advice crowd feels uneasy. In the 25 years from 2000 to 2025, gold yielded 95.6%. NASDAQ 46.5%. Let it all take root. For a quarter century, gold outperformed NASDAQ. Now, before you jump in front of me and say, yes, but stocks always win in the long run, let me tell you the real numbers. Last year, 2025, gold rose 65 to 6%. It was the best year since 1979. This year, it hit 53 record highs. 2024, gold rose 35%. The S&P 500 rose 3%. Pretty much 2023, gold rose 10%. S&P rose 22 points. That year, the stock won. 2022, gold rose 6%. S&P fell 13%. Gold is a better bet. Interestingly, if you look at rolling 30-year periods, of course, the average return on the S&P 500 is higher. The annualized rate is 10.6, negative 7%, and gold is 7.9, negative 6%. But this is important. This is when the system is running. Central banks are managing currencies effectively and responsibly. When real interest rates are reasonable. When government debt is not completely out of control, we are no longer in that world. Recently, a financial advisor at a top wealth management company told me gold is shining, but the returns are compound. Technically, that is right. But do you know what compounds are faster than gains? Fear, uncertainty, institutional behavior changes. That is what we're seeing now. Gold first hit $4,000 an ounce in 2025. Now it is about $400 or $600. Goldman Sachs expects that number to reach 4,900 by the end of 2026. But there is one thing most people miss. It is not just because gold has become more expensive. This is a complete reassessment of real value. Remember, February 2022, Russia invaded Ukraine. The West responded by doing something that shocked the world. They froze Russia's dollar reserves. Now, that may not sound important, but let me tell you, it has fundamentally changed the central bank's view of security. For 70 years, the dollar has been the global reserve currency. Because the United States is strong, the system is stable, and your money is safe in dollars. Central banks hold dollars because they are safe assets. Then, within a day, things changed. A large country's foreign exchange reserves have just been confiscated, not captured in the war. Actions against geopolitical divisions. What do you think the rest of the world's central banks have done since then? They started buying gold. Aggressive. We have data to prove it. China, long-term, large-scale buyers. Poland, in 2025 alone, they bought about 90 tons. Yes, Poland has become one of the world's largest buyers of gold. Turkey, steady buyers every year from 2020 to 2025. India, the main buyer of the entire period. These are not small countries to play with. These are the major economies that understand the global financial system. In 2024, the central bank bought 192 tons of gold. It is a record. In 2025, they bought 86 to 3 tons, though prices rose to the point that they were usually discouraged. Now, from 2024 to 2025, purchases are slowing, but when prices reach this high, this is expected. What matters is that they keep buying. They didn't stop. What really matters is that the central bank is now actively managing its gold reserves, not just passively holding them. In 2024, 37% of the central banks said they were actively managing gold reserves. In 2025, the share jumped to 44%. These are the institutions that really understand the monetary system. The renminbi plunged. Financial stability at the macro level. They also treat gold differently, not as a quirky alternative investment, as a strategic asset. The second most important asset class in the portfolio is equivalent to developed market sovereign debt. Consider that global central banks now consider gold as important as government bonds. When I heard the statistic, I realized it is not fashion. This is a structural shift. Let me be specific about why the rich do this. I want to be specific because that is where logic really works. First, monetary diversification. Stephen Jury, global commodities strategist at JP Morgan Chase Private Bank. His job is to finance the super rich. He told me one interesting thing. High net worth US customers looking to escape the depreciation of the dollar have risen significantly. You see, what most ordinary people don't understand is that if you have money, you don't think about making money. You're thinking about protecting it. If you have $50 million, all US stocks, and the dollar depreciates by 30%, your net worth will fall, even if the share price is flat. Gold is not denominated in dollars. It trades globally. You buy it in any currency and it holds its value. This is protection. Second, low correlation in chaos. There is a financial term, correlation. It is basically how much these two things move together. Stocks and bonds often move together, especially when markets become panicked. Both fell. Both will be hit. But what about gold? The correlation between gold and stocks ranges from low to negative. That is, when the stock market crashes, gold tends to rise. Now, during the 2008 financial crisis, the relationship frayed a bit and gold did not provide perfect protection. But overall, gold retains this protective quality. Research shows that even a 6% gold allocation improves the overall performance of the portfolio compared with a pure equity portfolio. For the rich who have amassed enormous wealth, losing wealth is worse than losing gains. So if that means they know they have protections and sleep better at night, they will get slightly lower long-term returns. Third, the reality of depreciation. I keep repeating that because that is the core reason. That is why the problem now is real interest rates. Remember, real interest rates are interest rates minus inflation. On 10-year Treasury bonds, you can now get a risk-free return of 4% to 1.6%. But real interest rates after inflation, they remain at historic lows. This is important because gold becomes attractive when real interest rates are low. Why? Because gold doesn't pay you interest. It just keeps value. When bonds fail to provide real returns, the choice between gold and bonds becomes closer. But what is interesting for the rich is that they're not just worried about bonds versus gold. They worry that the system will again be forced to loosen monetary policy. Logical thinking, astronomical US debt. The Biden administration is spending like crazy. Companies are grappling with the erosion of profits from high interest rates. History tells us what happens next. The Fed cut interest rates. They relaxed policy. If things get bad enough, they may even restart quantitative easing to print money. When that happens, bonds are destroyed. Stocks have become risky. But what about gold? Gold usually does well. The rich are not necessarily betting on a crash. Given the current pattern, they are betting on the most likely outcome. The result, more money. The renminbi continued to weaken. Fourth, geopolitical insurance. Tensions in 2025, really nervous. Trade, war, anxiety. Tensions between the United States and China. Middle East uncertainty. When the world panics, people don't run to buy stocks. They ran to safe havens. Gold is the ultimate safe haven. It has no counterparty risk. If properly held, no government can seize it and no company can go bankrupt. It is just metal, universal. Value is everywhere. Now, the rich don't necessarily think the end of the world is coming, but they understand that chaos presents both opportunities and risks. They want protection in times of chaos. Fifth, age and capital preservation. JP Morgan has found that as people get richer and older, they become more cautious. It is no mystery. If you've spent 40 years accumulating wealth, you are not trying to hit a home run anymore. You're trying to protect what you have. Gold outperformed growth stocks. 6. Trust factors. This is huge. Trust in government and institutions is declining. When I spoke to Ludwig Karl, he ran a Swiss gold safe. They run vaults deep in the Swiss Alps for super rich clients. I asked him, who are your clients? Most of our customers come from first world countries, he said. However, our customers have low trust in the government or the financial system, or are trying to establish backup or insurance plans by holding precious metals outside the banking system in a neutral and secure country. That is why people no longer trust the system. This is not prejudice. This is rational. They saw the government freeze assets. They went through the financial crisis. They see the central bank making mistakes. Safe holding of physical gold outside the traditional banking system is the ultimate backup solution. One JP Morgan client even told them she planned to grow gold bars in the garden. This illustrates how some very wealthy people see this. This is not an investment in the traditional sense. It is an insurance policy against the collapse of civilization. Now, if I don't call the elephants in the room, it is dishonest. Warren Buffett hates gold. He called it almost the last thing he wants to invest. His argument, gold doesn't produce anything. It won't get a dividend. It has no cash flow. You buy it, you hold it, you want it to appreciate. That is it. He was right. Technically, gold is not as complex as corporations. The S&P 500 has averaged an annualized yield of 10.66 to 7% over the past 30 years. The average price of gold is 7.9 negative 6%. So Buffett was right about math. What is the problem? He is applying yesterday's math to today's world. When real interest rates are reasonable, when the government is fiscally responsible, when the dollar stabilizes. In that world, Buffett was right. Stocks continue to beat gold, but we're not in that world. A financial advisor to a top wealth management company said bluntly, gold is unreliable as a long-term investment. If long-term refers to 30 years in a normal economic environment, that is true. But what if the economic environment itself changes? What if the era of central bank manipulation and unlimited money printing is the new normal, and then the old strategy books don't work? And that is what the rich are betting on. They are not betting that gold will beat the stock market forever. They bet that gold will protect them better than stocks over the next 5 to 10 years as the debt crisis intensifies and central banks are forced to choose between raising interest rates, breaking everything, or printing money, eroding the currency. This is a fundamentally different view from stocks always win. Based on what we saw in 2025, this argument is beginning to make sense. I want you to understand the rich haven't given up on stocks. They're not saying never buy again. What they are doing is rebalancing. Given their geopolitical and monetary context, they are pulling money out of overvalued assets, struggling in macro environments like growth stocks, and moving it to places that are ignored, undervalued, and now suddenly meaningful. This is not an emotional move. It is a math problem. Gold returned 60 to 5% last year, while the stock market was flat. Wealthy investors doubled allocation. The central bank quietly shifts reserves. Prices hit record highs. None of this is a coincidence. They are symptoms of the stress system. The rich see this earlier than others. Now, what does that mean for you? That doesn't necessarily mean you should go all out to buy gold. It is as foolish as ignoring it altogether. You need to understand how the game changes. Monetary dynamics are changing. Trust in institutions is declining. Debt levels are unsustainable. In such an environment, a small gold allocation, perhaps 5 to 10%, becomes insurance. Not get rich quick, but insurance. The kind of insurance that really rich people already buy. The question is, how long will it take you to do it? If you think this is valuable, click the subscribe button. Click the like button. Leave a comment and tell me, are you considering adding gold to your portfolio? Because the rich have moved. See you next time.